Let's take a minute to look at something I call the TFSA bite. TFSA's tax-free spending accounts started in 2009, so they're 4 years old. Now, the amount you can put into a TFSA and tax shelter any growth on that money is independent of your income. If you're a Canadian resident over the age of 18, you've been getting $5,000 a year for the last 4 years. What's unique to TFSAs is withdrawals can be made and there's no tax due on those withdrawals. They're tax-free withdrawals. So these are starting to catch some steam. They're getting some feet under them. TFSAs have now exceeded over 8 million accounts in Canada. There's about $60 billion of assets within those accounts. So just a quick reminder for you, what's different between a TFSA and an RSP? Well, TFSAs have contribution room that's independent of income. So in an RSP, a retirement savings plan, it's 18% of your earned income to a certain max. A TFSA is independent of that. That's good. The other thing about a TFSA is your withdrawals are not taxable. You can take money out of the TFSA and it doesn't create taxable income. That's unique to a TFSA. And then finally, a TFSA, you can put the money back into the TFSA. And withdrawals from a TFSA create contribution room. And that's different than an RSP. When you take a withdrawal out of an RSP, that contribution room is gone forever. So that's a quick review of TFSAs. What's the TFSA bite? Well, let's look at a case example. Let's say in January, we have a taxpayer who had never had a TFSA before. It's 2012, $5,000 a year. That's a $20,000 opportunity. So they put $20,000 into the TFSA. Sometime in the summer, they're on a road trip, let's say to Gold River, BC. They need to buy a new car. They pull $10,000 out of the TFSA and they go buy a new car. Everything's fine so far. Then in the fall of 2012, a couple months later, they get some cash back in their jeans and they decide to replace the money in the TFSA. They put the $10,000 back. Is there a problem with this? Well, according to at least 76,000 Canadians, not so, but there is. The problem is a TFSA only allows you to replace the money in the next calendar year. So contribution room is any unused amount plus any previously withdrawn amounts from the TFSA. So if you were to put that $10,000 back into the TFSA in the fall, in our case example, you would be in an over-contribution position until the next calendar year. This is not a small issue. Over-contributions attract a 1% penalty per month. So in this example, $10,000, we're looking at $100 a month in just tax penalties for having made that mistake. So this is something that it looks like at least 76,000 Canadians might have made the mistake. CRA is sending letters warning people they think are in this position. And what you need to know is there's a good chance you can, if you had it was just a bona fide mistake, it was an oversight, there's a good chance you can appeal to CRA and have that penalty reconsidered. That bites either way. I'm Quigley. I'm from Qube Benefit Consulting in Edmonton, Alberta.